Is the global economy sliding into a dark trap? Just yesterday, the release of the Core PCE Price Index, the Federal Reserve's absolute favorite inflation gauge, sent shockwaves through Wall Street. The numbers came in red hot, completely crushing expectations and destroying any hopes of a 2026 interest rate cut.
That is correct, Liam. The data shows core inflation rising by a stubborn 3.2% year over year. When you combine this relentless inflation with stagnating GDP growth, we are no longer talking about a temporary cycle. We are looking directly into the jaw of the monster, stagflation.
Today, we are arming you with the data-driven truth. We will break down exactly why this PCE shock happened, why the Federal Reserve is completely paralyzed, and most importantly, how you can shield your portfolio from the stagflation trap. Alice, let us start with the basics. The media always screams about CPI, but why is this PCE release causing central bankers to panic so much behind closed doors?
Think of it this way, Liam. CPI is like looking at the price tags on a supermarket shelf. But PCE, personal consumption expenditures, is what people actually buy and how they substitute expensive steak for cheaper chicken when times get tough. It is the Fed's ultimate reality check, and right now, that reality is grim.
And the biggest agitator here is energy, right? The ongoing conflict around the Strait of Hormuz has sent crude oil skyrocketing, feeding directly into the cost of literally everything we consume.
Exactly. It is a classic supply-side shock. When oil prices spike, the cost of manufacturing and shipping goes up. Businesses have to raise prices, but because consumers are already stretched to their limits by high interest rates, they stop buying extra goods. That is how you get high inflation and economic stagnation at the exact same time.
So the Federal Reserve is completely cornered. If they cut rates to save the slowing economy, inflation explodes. If they raise rates to kill inflation, the $39 trillion debt crisis implodes. Is there any way out?
Historically, no. The Fed's tools are designed to manage demand, not supply shocks. They cannot drill more oil or fix geopolitical supply chains with interest rate hikes. As Fed Governor Waller admitted, the only option right now is to sit and watch while the economy bleeds.
This is a terrifying scenario for everyday investors. Alice, what is the 5-minute action plan to escape this stagflation trap?
First, avoid paper cash and long-term bonds. Inflation will eat them alive. Second, accumulate hard cash-flowing assets like commodity-linked equities, energy sectors, and robust technological value. And third, treat your personal skills as your greatest inflation hedge. Knowledge and adaptability cannot be devalued by a printing press.
Knowledge is the ultimate shield. If you found this breakdown valuable, hit that subscribe button and join the 5-Min Smart community.
And if you want to support our mission to keep these deep dives completely independent and ad-free, check out our support link in the description. Your support helps us keep these deep dives ad-free and independent.
Let us know in the comments. Do you think the Fed will be forced to raise rates again? Or will they let inflation run wild? Let us debate below. Thanks for watching 5-Min Smart. Stay smart, stay ahead.